This is a recording of the harmonic trading presentation given February 28th, 2009. In this presentation, we discussed what is harmonic trading, where did it originate, and some of the basic measurement strategies that comprise the entire approach. We also looked at some current markets and looked at a few price projections based on some of the strategies that were presented. Due to some technical difficulties, we were unable to fully record the program, so this is a quick overview of what was presented and informally looking at the slideshow that was given. Harmonic trading is a price-based analytical approach that utilizes pattern recognition strategies to measure and to predict future market trends. Harmonic trading employs exact alignments of Fibonacci-derived ratios to define unique price patterns in the financial markets. This methodology assumes that trading patterns or cycles, like many patterns and cycles in life, repeat themselves. In its application to the financial markets, trading cycles of buying and selling can be quantified and distinguished as specific technical entities that manifest consistent behavioral price action. When these turning points are identified correctly, trades are executed at a price level where the cycle is changing. Essentially, this type of trading is respecting the natural ebb and flow of buying and selling. In doing so, these trades are executed in harmony with the market. Most of the harmonic patterns are 5-point structures, meaning there are 5 distinct price legs to each pattern, and although all patterns are based on the original ABCD pattern, the various ratio alignments that were laid out in the harmonic trader have defined most of these structures as they're known today, and also serve as the most precise means of quantifying these type of structures that might look similar. But when they're classified according to the ratio alignments, they can be measured and categorized as distinct price structures. And that's probably the most important concept of all harmonic patterns, is that they look to measure, identify, and quantify unique situations and that are represented structurally by these different patterns. The importance of exact pattern specification within the harmonic trading approach is the underlying element of the entire methodology. And in this one slide, it's a very basic question to look at 2 letters, an M and a W. Does this M look the same as the other M? Is this W the same as this W? Although if we're looking to spell out a word, an M is an M, so it wouldn't matter. However, if we were presenting something on paper and presentation mattered, you would want to make sure that you had you were looking at the right text, the right font. In the same way, when you're looking at price charts, it does matter, because when M and W type structures are used to identify price legs and price trends and try to label the price history of a chart to determine how far a market is traded, what the prior support or resistance points may be, this specification is critical and is the most important principle of harmonic trading. Of all the patterns, the Gartley pattern is the best known. and it's quickly becoming as well known, I think, as head and shoulders pattern. Although most people know the Gartley pattern, most people who are practicing this type of approach, using this type of analysis, tend to label most markets that possess any type of M or W structure as a Gartley. And the problem is that, again, when you lack that specification of trying to identify these structures as unique entities, as although they may appear similar, they're still different in terms of their ratio alignments. It becomes more difficult to have a consistent approach when your measurement strategies are not. And basically outlining any, labeling any M or W structure as a Gartley pattern when it comes to real-time trading scenarios leads you down a road of inconsistent strategies, that you're not using the same approach, the same model of identifying trade opportunities based on a specific set of criteria. So most important concept though is to focus on the structure first, and H.M. Gartley first outlined the basic structure of this pattern in his book Profits in the Stock Market in 1935, but he did not assign Fibonacci ratios to the price structure. Profits in the Stock Market did not mention anything about Fibonacci ratios in the entire book, which is quite unusual since most people assume that he's responsible for assigning ratios to the structure. And this is where the great Gartley controversy now lies, is that you have the popularity of this structure because when a valid Gartley structure does yield an exact reversal and it can be identified in advance, it can seem like a pretty spectacular trading tool. The problem is that consistently over time, if these price structures are not identical in ratio and proportion and possess the same price action, then you're comparing apples with oranges essentially. And this is really my first challenge, that when I first started studying technical methods that focused on price structure analysis, be it Elliott wave or other theories, and then combining some type of ratio analysis, if it's basic Fibonacci ratio application or measurement strategies, or if it's something more sophisticated, looking at standard deviations, whatever the measurement strategy is. What really appeared to me to be the most important concept is to try to identify all of these different patterns that look similar as unique situations, and then be able to define what the situations are, figure out how they act the same, how they act differently, and then develop rules around those standards. From a very basic standpoint, it's difficult to go off tangent and discuss all the strategies that are used to try to make those determinations. All of the information for the identification and measurement strategies are on the Harmonic Trader site. The more advanced strategies of how to handle the situations are in the books. But for the basic trader that's new to this information and needing to make an assessment of whether or not this is valuable for their own trading plan and what they're currently doing, the most important concept is to understand that these classifications of price structures provide additional information that other approaches don't measure, and that is the uniqueness of Fibonacci strategies and harmonic trading in particular. Some of the advantages over other basic technical methods that are out there. Elliott wave and other Elliott wave type analysis uh, tend to yield a number of different possibilities for the same scenario. And when it comes to harmonic patterns and defining harmonic trading situations, there are so many rules that are required to be satisfied to define each pattern as a valid trading opportunity and define a valid pattern structure as really a tradable completion point. Uh, these are all. It's very important to keep in mind that these rules are employed for a reason, to be specific as possible, to find only those patterns that truly fit the description, and then employ the same strategies as and the same trading model in general in terms of trade management as trade identification to handle the trades. And basically, we're talking about trying to turn patterns into profits. So the big deal about the whole controversy is that when it comes to real-time trading situations, it is essential to be as exact as possible to optimize the executions and to reduce risk. Furthermore, the classification and specification of these patterns is a relatively new concept within the field of technical analysis, and that's, I think, one of the most surprising things that people learn when they first begin to read about these strategies and really begin to explore the entire approach. And 10 years ago, most of these patterns did not exist. The rules around the Gartley, or what has become known as the standard definition of the Gartley today, did not exist, and Fibonacci ratio analysis was really scoffed by most. Was considered almost in the class of astrofinance, which most feel is not a valid area of technical analysis. Astrofinance or astrology to make financial decisions has nothing to do with harmonic trading and is frequently mixed into the bag of voodoo that tends to be thrown out there as holy grail type methods of some type of secret edge of astrology or moon cycles or other things that are not measurable approaches. And what we're talking about within the harmonic trading approach is using ratios to measure and classify price structures, and then analyzing those price structures with other technical tools to develop market decisions. And really, anything beyond that, and anything that especially when it comes to Fibonacci ratios, that may be thrown into that group of strategies that may seem to have some kind of mystic advantage, really is just not useful and is not very practical when it comes down to measuring support and resistance levels and measuring potential areas for reversals and trade opportunities. And that's really beyond the math of harmonic trading is not much. There's really just about measuring price action and using specific strategies and tools that are all measurable. So it's we're not doing any kind of black box type stuff here. It's just take some time to study the strategies, understand what the rules are, and begin to incorporate what this type of approach can offer with your existing strategies and your existing tools, and then developing that real market experience of learning how things unfold from this structural basis. So, but in real trading situations, that is the most important concept, is to be exact, because to minimize risk and optimize the overall decision of whether to buy or sell and where and how to handle those trades. I want to take a quick look at the two most popular patterns, the Gartley versus the bat pattern. And the Gartley pattern, that is the common definition today, that being a simple ABCD structure with a ratio alignment of a 618 at the B point and a 786 at the D point. That exact alignment, in my approach and my experience of what works, usually is the most tradable and reliable structure of all of the M and W type patterns. A really nice Gartley pattern usually, and not to get into sidetracked in terms of statistics and because there are a lot of even misquoted statistics, but I'll just say that the accuracy of Gartley patterns to identify valid reversal points is substantially improved when the alignment and the ratio and proportion of the structure is ideal, meaning each ABCD point reverses at one of the ratios. The structure in general has a real nice symmetry on the chart, and we'll look at a couple examples here. But most valid Gartleys are of the most exact ratio alignments of all the structures, versus the bat pattern is a variation of the Gartley where its midpoint, or the B point, which is the most important point of all of the patterns, sits higher within the range of the structure, and I'll go over this in a minute when we look at some charts. But the bat pattern versus the Gartley pattern is really the first major issue that harmonic trading attempts to solve, because not only does this controversy begin the entire identification process of all of the structures, but it also emphasizes the importance of looking at similar price structures from different viewpoints and applying different rules of how to handle this type of specification. So let's look at the Gartley. Just an example of the bullish Gartley first. And here's an M structure starting at the X point, which is usually some type of critical low, distinct low, followed by a reaction up, and this begins the entire setup of the pattern, where the A point will begin here but retrace to the 618 of this initial move. So you have the move X to A, and this is the most important retracement of the entire structure, where the B point will come very close, if not exactly, to the 618, the 61.8% retracement of that initial move. Followed by, sorry about that, back up to C here. And then after the C point stays below this A and begins to retrace at one of the harmonic ratios into the CD leg, this is where we then look up for our equivalent A to B, C to D, equivalent down or zigzag completion with a BC projection, all in the 786, the 78.6% area of the initial XA leg. So this M type of structure keys right here at a 61.8% B point retracement. Then the other measurements are done to project the D area down here. Here's an example. It's a 13-year chart of the Japanese yen versus the dollar. And the incredible thing is that down here at your initial point of X starting in 95 was the first low that set up the entire structure, followed by A, down to a near exact retracement of the 61.8% move of that entire 1995 to 1998 rally. After a multi-year rally up to the C point, then it started to roll over. Now, the interesting thing is that although it took several years longer than the ideal ABCD, that is A to here, B to here, and then taking that move, projecting it an equivalent move down to off of the C high point, probably would have given you a time symmetry of somewhere around 2003, 2004. But we're focused on price, and in this situation, despite the fact that it took a few years longer, the most important concept is to see that this B point, this midpoint of the M structure, is what keys us for the eventual 786 completion. Now, had this B point been higher, which would result in a bat pattern, typically that type of structure would yield a bat pattern and would be a much deeper retracement eventually down here to around 80. But I'll show a chart here in a minute of what a bat exactly is and how to look at the differentiation of the structure to know that it's a bat. But my point is that this 618 retracement at the B point is what's responsible for identifying the whole M structure as a Gartley with a corresponding 786 and then ABCD. The ABCD completed down at 87 and change. The BC 127 was about 92. Now let's look at that potential reversal zone just over the last few months. This is a weekly chart. The ABCD was 88.77. And then here are the other numbers. But looking at this zone and looking at how this stabilized after the complete test of all the numbers in the pattern, and again with the B point serving as the identifier for the whole structure and the eventual completion of the pattern down here. There's our 786. Our other numbers are lower in the zone. Really, with these numbers down here close to 90, and 90 being such a psychological number, as that got to 90 or under 90, that would be the area to really start looking at it, and especially with the ABCD just under 89, that would be the real key number with this type of alignment in the zone. But again, that the most important concept is to really take away is that we're looking up here at 90 or just under 90 versus if it was a bat pattern, we'd want to wait till 82.50 or lower. So let's look at a bat pattern. A similar M-type structure, bullish bat. Here's your X point, there's your A point, there's your B point, C point. Now the B point here is usually at a 50% of X to A. So if X to A is just say 1 to 101, and then come back, retrace 50.5. You know what I mean? We come to the 50%. And then followed by a C point retracement. Sets up the whole deeper move and a more extended M-type structure down to the 886. Again, not to rush through the identification strategies. They're all on the Harmonic Trader site. But the broader concept is the whole idea of the specification of the patterns and the importance of looking at these structures, albeit similar, as unique technical entities that require different rules for trade execution, trade management, and even trade identification. So here's an example. This is actually a 5-minute chart of the same Japanese yen. Looking here, down here at your low X point, followed by your initial rally, and then here's again your 50% retracement. Just a couple ticks off of that 50%, but again, we're not looking. If it was a 618 retracement, we would be looking something down in here, but since we hit the 50 and we're under a 618 B point, this sets us up for a deeper eventual retracement. Here's your potential reversal zone of the 618, the 1618 BC projection, and the 886 XA, and then the alternate extended ABCD. All of these point to just under 91. However, if this was a Gartley, we will be looking at a higher zone. As I mentioned earlier, a lot of the ideas that and strategies that I've released in the books have just been as a result of years of research and the ideas and strategies that worked for me. I've explored almost all of the trading systems out there, I think, and have looked at many different ways to analyze a price chart. And the kind of the whole concept of measurement strategies and looking for those measurement strategies that gave me the best insight to what was happening and where the markets might be going based on that analysis is how the whole harmonic trading approach has evolved, how my trading has evolved, and really how I have gotten to the point of where I am today with just the entire collection of strategies now representing what I think is a thorough approach from start to finish that shows you how to read the information, identify the information, and execute that knowledge, trying to turn patterns into profits. And some of the stuff, as I said before, that are unique discoveries within technical analysis is the theory of harmonic ratio alignment to distinguish similar structures as unique trading situations, and proving that not all patterns are the same, a la the Great Gartley controversy, as I've discussed, and just again looking at all price structures and looking at trends in general, if looking at price history and price trends, and applying strict measurement strategies to analyze the extent of what has happened and possibly what will happen. And that's the most important goal of all of this analysis, is to try to kind of measure on the roadmap of what is happening, and based on the identification of this price history based on what has happened from the past, is really our goal, to map out what's going to happen, and that really puts all of our analysis in price history alone, turning off the TV and turning off the news in general, and using strictly technical tools and price analysis to generate trading decisions and ultimately profits. Some of the other new ratios that have been presented in the books and some of the articles that I've released are new in terms of identifying complex structures and identifying technical situations. Most of the patterns that are within the harmonic trading approach have been defined within the first three books, and just the entire kind of arsenal of patterns that in my opinion are the most reliable structures to generate information from looking at the overall structure of price movement. Again, all of this information is on the Harmonic Trader site. The Harmonic Trade Management Model utilizes a specific set of trend line analysis, a few trailing stop strategies. One of the probably the best known trailing stop strategy is the 382 trailing stop strategy that was presented years ago, that I initially released in the Harmonic Trader as a means to gauge price action, and essentially if you're looking at a reversal off of a specific pattern and it is retraced 38.2% of that initial move, typically then that would signal that the trend is either reversing or that it's not, the pattern might not be completing, and the pattern might not be as valid and yielding as large a reversal as what you thought previously. So that's just one example. The other strategies are in the books of how to specifically handle trade executions once a pattern's identified and you look into executing within a zone and you're into the trade, and then it reverses from that zone, and how to handle those situations. And finally, a lot of the confirmation strategies that are unique to harmonic trading, and namely the RSI BAM, which is the relative strength indicator strategy that was released in Harmonic Trading, the Financial Markets Volume 2. That is a unique way to look at pattern completions and using relative strength and a specific type of relative strength formation to confirm whether or not a pattern may be a valid trade or not. And it's, again, all of the information is on the site, and it's not to get into really too deep of what it is, but the general concept of using other technical methods and other technical strategies that are have been around for decades. Wells Wilder is the one who came up with relative strength in the 1970s, and that's just one oscillator method that he used and he came up with. So there's a lot of different tools that can be added to the basic structural approach. I've identified a few. I'm sure there's many out there that work well once you implement the kind of the structural information that harmonic trading yields. But it just, that understanding that harmonic pattern completions themselves is not an entire trading system, and that harmonic trading pattern completions require confirmation, require other technical methods to give us the same result to confirm whether or not we have valid trades. So those are some important concepts to keep in mind, especially that a lot of these rules, a lot of the strategies are relatively new within the last 10 years. So I'm going to take a quick look at some recent action in the Dow Jones Industrial Average and the S&P 500 from last year. I had not really done any reports. I've kind of been outside of the web business since 2004, 2005. I ran Harmonic Trader from 2000 to 2005. And I did market reports every month on the major indices and other indices that had unique situations. And as things were unfolding towards the latter half of 2007, uh, I started to see some things that were disconcerting, but were still quite a ways away. And then, as the end of 2007, 2008 really started to tear the markets apart, a few situations developed where I felt compelled to at least put some things on the site and just show a few of the patterns that were developing on a weekly basis that really defined make or break areas and that things that were probably some of the most important technical developments of the past 10 years, and that's probably what started me to take a look at what I'm doing on the internet and what harmonic trading is doing on the internet, and start to put some things out there that might reflect um, more of the concepts of what harmonic trading represents versus what a lot of the public was saying, because it did seem that the market was giving us signs from a harmonic trading perspective that things were worse than could have been anticipated otherwise. So looking at the Dow Industrial Average and the S&P 500, really the industrials were the first to give us some structural signals that we had major pattern completions to consider, and namely it was a considerable 5-0, a weekly 5-0 pattern that started from the 2002 low. And in my 2008 July report, I wrote that the Dow Jones Industrial Average has sustained remarkable damage in the past 12 months. Although the index recently declined sharply, the index has formed an exact 5-0 pattern on the weekly chart. The distinct structure clearly points to a critical technical test in the coming months at slightly lower levels. The formation of this structure must be considered as one of the most significant technical events of the entire last 6 years. From a harmonic trading perspective, the price action at the completion of this pattern will provide significant indication to the long-term prospects of the overall state of the market. Until these are tested, the trend remains down. Now, in March of 2008, I gave a presentation, and it was the first one in about 3 years, to a small trading group of about 30 or 40 people in Atlanta for a friend of mine. And this is when the Dow just started to roll over and begin to accelerate to the downside. And one of the key areas was the 2002 to 2007 38.2% retracement. So we were looking at, from the 2002 low, the Dow had already retraced nearly 40% of those gains, and it didn't seem as if it had fallen that much, but quickly the entire situation was coming together, and so at that presentation and in this report, I really stressed that there was a few things developing in the mid 10,000 area, 10,005, 10,006, and I'll show it was a considerable 5-0 pattern that really didn't look like it was going to hold. And it was, in the report I said, a failure beyond the mid 10,000 area would essentially trigger a massive continuation and an eventual retest in the entire 2003 low. And this was in July of 2008, before the index really crashed and was still above 10,000. But again, in that report I said the eventual test of the mid 10,000 area will dictate the long-term action. And so here's what we had is a weekly bullish 5-0 pattern. But problem is that price action was really falling apart quickly into this area, and even if an initial test of the area gave a small bounce, which is what ended up happening, any kind of failure below this level, 10,005, 10,400, then there was serious consideration of the entire market of the last 6 years being retraced, and that's what we were looking at. We were looking at this 2002 low down here at around 7,500 and having a distinct 5-0 weekly pattern, all sitting here at the psychological 10,000 level, gave us just a lot of indication of how substantial of an area this was. And soon after the violation, it started to really fall apart, and the other indices as well started to fall apart, namely the S&P. And in my September 2008 report, I took a look at the S&P 500 and I said, the indices must stabilize now or face the possibility of an entire retest of the late 8 years of price action. Specifically, the S&P 500 would trigger a much lower downside target at 880. Therefore, the recent lows must stabilize and begin to follow the upside to confirm the substantial rally or face a full retest, all of that. So, and the S&P 500 is representative of the state of all major equity indices and must find support in this general area. This index has hit a penultimate support area that represents a definitive make or break. I mean, that's, pretty much all of that, the pattern, not only in the industrials, but now in September 2008, the S&P 500, here was its 50% retracement. But here's what we were talking about, was right here at about 1170 is the completion point of the S&P 50 pattern. But one of the aspects of a 50, and it doesn't matter what time frame it's on and what market it's in, if 50 patterns fail after a brief correction of some sort, now there was next to no correction and no bounce even off this area, what typically happens is you get the formation of a bad pattern and you get this a downside continuation from the 50% down to the 886. This is a principle that I cover in Harmonic Trading of the Financial Markets Volume 2, but for right now, from a general sense, that's how I was looking at it. And this definitely happened more quickly than even I thought I anticipated, but still, structurally, on the weekly chart, that's what it was indicating, and those were the reasons why an entire retest of the last 8 years or last 6 years were likely. And from those simple structural signals is how that analysis was generated. So now what? Even after today, now what? We've got a number of different things happening, and essentially the Dow and the S&P have formed the same structure and are facing similar technical areas. So let's look at the Dow. Here's the last 20 years for the Dow. And this is a rather general trend channel, but even the most liberal of trend channels are saying that this uptrend of the last 20 years is violated. And we could even draw this is off of the 87 low, but that is a very simple picture of looking at the last 20 years, and we're faced with, from a technical perspective, looking at what might happen in terms of 1987. And 1987 can be argued was the low of the most recent rally, but some say 1982, some will take it as far back as 74, but technically the last major substantial crash other than the bear market of 2000 to 2002, but single technical event to mark this low is the 1987 crash. So even from that perspective, from the 20-year perspective of taking it off the 1987 crash low, we're well below that trend channel, and now we need to look for something structurally that's going to give us signs of what might happen. And we clearly, on the Dow, now that we're well under 7,000, now what we're looking at is the entire 1995 to 2007 retracement. Essentially in 1995, 1994, the Dow was banging at 4,000 and couldn't get through it. Took most of 94 to get through it. But by 95, after it broke out, I was on the run. So from that perspective, looking at that, if we took out this market, we have two different markets from 1995 and before 1995. And if we're reverting basically back to this trend line, then that's pointing us lower. And we can assume that the 1995 rally starting at 3,600 up to the 2007 peak above 14,000 is fair game. It's not going to go straight down, but it's fair game. And this is what I was really emphasizing on Saturday. If we took away the price label, price axis, the time axis, and I was just looking at this structurally, there's really not much here other than one of two scenarios. The first scenario was looking at 8,000, 7,900 on a shorter term basis. We had a 50% retracement of the 2000 and the 20-year run off the 87 low. But what's more likely here is a reversion back to this trend line that started in the 87 low, and now that trend line runs us up also to the 20-year 618 retracement at 64.50. This is important. This is really important. Why? For a number of reasons. People that know that have studied harmonic trading and understand how these patterns unfold and how harmonic ratios even unfold, is that even if this fails, eventually fails, more likely than not, we're going to see some type of bounce at this major level. We have a few other numbers and pattern completions down here, but simply looking at the charts and looking at where, like a magnet, where this is being drawn to, once we had the violation at 7,900, really there was only the next place to look was the 618 at 6,400, and it's actually even lower than 6,400. But what we have here, and this is stretching it, is not even a distinct pattern, but interestingly enough, what we possibly have is an alternate bat structure where you have a very shallow B point, and then you have this M-type pattern, but you have a shallow B point, and your pattern completion is lower. The 113 extension off of the 2002 low, sorry, actually here, let's go to the next one. This shows it better here. Off of this low, the 113 is at 62.58. So essentially between 62.50 and 64.50, we have several things that are converging here. It's not a nice structure. There really isn't much in a way of structurally that would even confirm this on a daily or even on a monthly. I mean, we have a simple 618 retracement. We have what I would call a sloppy alternate bat. And an alternate bat is not a pretty structure, but the reason why, again, on this chart it shows it better, is this yellow line, this 382 retracement here at the B point. And I remember that that rally from last year was almost exactly off of that 382 intraday, and that little pop and then roll down. And once we took out this 382, that's when I started to get concerned that was actually, I gave that March presentation right in here, right in this little pop area. But the fact that it responded so well to that 382 retracement and then took it out sets up, just by the simple model itself, sets up an alternate bat. And with the way we fell apart today, I would expect to see some type of test down there sooner than later, probably by the end of the month, before the first quarter's out. But that's kind of the thinking, is that we're looking for a major technical test, some type of technical event to define what has happened so far this year. And it's going to happen in the first quarter, and it's likely going to be down here at these levels and complete the structure. Now, what happens beyond that structure, I would have to say that if we go sideways at best with a little rally initially, we're going to be lucky. And preferably you'd want to see some stabilization there and then take its time. But I don't even want to get into what might happen under 6100. We would, although we would know pretty quickly if we do fail this area. If we fail 6100, you forget about it. But for now, just looking at the weekly charts and looking at what possibly would be here, that's our next area, and that's going to probably happen pretty soon. So looking at some of those charts and looking at some other well-chosen examples, it's important to know that harmonic trading measurement strategies effectively gauge critical areas of support and resistance unlike any other method. And it's the tools and the measurement strategies that we use are unique and were created because they worked. And it's really just it was a backwards approach in terms of how these strategies were refined, that over time I continually went with the ratios and the structures that led to the most reliable price action and led to the best trading opportunities. But again, we're using strategies that really are unique and define support and resistance unlike any other method. Harmonic patterns serve as important structural signals that must be respected. And again, this gets into the pattern specification and the importance of looking at similar structures as unique, but structurally, harmonic patterns do give us a lot of technical information that must be respected. And finally, harmonic trading requires precise rules to identify potential trading opportunities, to distinguish valid price patterns, and optimize all trading decisions during the process. And it's, as you further get into this study and research the more advanced strategies and integrate them with your own current trading plan, you're going to realize that the specification and the exactness of these measurement strategies are the advantage, and it's kind of what keeps you disciplined in your approach, because that's from a general perspective, consistent successful trading requires a level of precision and exactness where there's no gray matter. It's the gray matter is letting a trade slide, or there really being kind of somewhat lax in trading, as most know, will cost you money. And that's, I think, what we're talking about here is when we're talking about optimizing trade zones and execution areas, we're talking about money, optimizing money, and not being complacent in what we're doing and trying to read as much of the market signals that are being presented as possible. So from that perspective, the structural signals and the structural um, advantages that harmonic trading provides are unique and are unprecedented within technical analysis, but still require other standard technical tools, and I encourage other technical oscillators or indicators to be integrated. And I think you'll find that many of these work well and work in concert with the basic structural approach of harmonic trading. So thanks for taking a look at this, and if you have questions, feel free to contact me at the site harmonictrader@harmonictrader.com. Thanks.